Hello, everyone. Thanks for joining us. We'll get started in a few moments. All right, well, I'll get started. People keep joining. We'll just go on. Just a few pointers before getting started, though. The session will be recorded, so if you're not able to stay the whole time, or if you came in late, or if you want to share it afterwards, we will be posting this in our YouTube page. So feel free to share that tomorrow. As well, if you have any questions, I'll be keeping an eye here on the chat as well as our team. So feel free to ask questions during the presentation, and we'll also have a Q&A at the end, of course. Without further ado, let's get started. All right, so the agenda for today is about bull markets, specifically the current one we're in. So first, I'll give a brief overview of previous crypto bull markets in its just over 10-year history. Then I'll focus specifically on key Bitcoin indicators, as well as indicators for Ethereum and other smart contract platforms. And finally, on the emerging sectors that are sort of leading the way in this new cycle. As usual, though, first we'll provide a quick update about Into the Block. So we launched more partnerships with exchanges as usual. We launched it in Todex, Turkish cryptocurrency exchange, also in Bitcoin Courier, German news site. For Dash, one of our existing partners, we were able to expand on the partnership, being the first to launch Dash exchange flows, tracking inflows and outflows of Dash tokens in and out of exchanges. So since it's the end of the quarter and the beginning of Q2, I just want to give a brief overview of our Q1. It's been a very successful quarter for us at Into the Block. We managed to double the number of subscribers in our analytics platform, over 20 new partners, such as the one I just mentioned, and as well as growth in our quant services division. And for Q2, we have ambitious plans. We want to keep providing leading indicators for you guys, and we have the plans to revamp both our ownership and social indicators. As well, we want to provide the leading source for NFT insights out there. So we're working on that. And finally, we're working on the support for more DeFi protocols such as Curve, Balancer, 1inch, to keep expanding our DeFi insights section. All right, so let's get started with the overview of previous bull markets. So a lot of this is public knowledge, and I expect a lot of you in the audience to be relatively familiar, but I'll dive in quickly. So the first, of course, Bitcoin was initially created around 2009, launched in 2010, and had its first bubble in 2011. And in terms of price, this will be probably the only section where I'll be discussing price, but it went from 1 cent to $30, back down to $2. So that's 3,000x within a year. Then in 2013, it had the double bubble. So one bubble, I believe, was in April, from $2 to $270. And then in November, it went from $65 up to $1,200 in November. And in this bubble, we also saw the emergence of altcoins. So the first few alternatives to Bitcoin, with Litecoin, Ripple, and Peercoin sort of leading in that wave. In 2017, we saw the ICO bubble. Bitcoin, of course, managed to have spectacular returns, as in each of these bubbles. But we also saw the narrative of ICO investing powered through the ERC20, the creation of the ERC20, which of course was the token standard that many of these platforms use to raise money through Ethereum. And altcoins through this bubble managed to gain over 70% share of the market. So many of you that have been in crypto for a while might be familiar with this sort of pattern, but I believe A16C's framework around it puts it in a great way. It's essentially what they call the crypto price innovation cycle, which has been the case for the past bull cycles that I described. Essentially, it consists on price driving attention. Through this attention, there's entrepreneurs that come up with new ideas that essentially push the space forward, which in turn drives further price in the next cycle. So in 2020 market, we've already, in terms of attention at least, we've already surpassed the peak in 2017, of course in price as well. And I put into perspective both crypto and blockchain as search terms, since crypto is usually associated with the speculative part of it and blockchain more with the technological. You can see here the trend when the bull market goes into full effect. You see sort of crypto searches spike significantly, while blockchain doesn't really spike that much. And in this bull market, we've seen broader adoption, which I'll get into later. And we've also seen the emergence of deep decentralized applications with actual traction rather than the vaporware of ICOs. So let's dive into key Bitcoin indicators in this cycle and why you need to know about them. So through the distribution of ownership on chain, we add into the block, we derive this indicator called unspent transaction outputs age, which sounds like a complicated indicator, but in reality it isn't. And essentially through UTXOs, we're able to track the distribution of each of these addresses and how long they've held these tokens for. And we split this through time in percentages. And we've seen time and time again that in the bear markets, we see the long-term players stay, which leads to an increased percentage share of holders of over 1 year, which you can see here in the green and blue colors in the waves here. Aside from that, sorry, I just got a comment in the chat. Aside from that, once the bull market goes into further effect, we see short-term interest renew and the cycle restart, as we have been seeing here with the orange and red waves leading to further interest from new players and, of course, increased price action. So in 2021, there's been many narratives and driving forces for crypto and Bitcoin. I've identified these three as sort of the ones I believe to have had the most impact so far, which are broader adoption, Bitcoin as digital gold or as a form of store of value, and institutional dominance. So these are, of course, interconnected, but they have been leading so far the way. So before, I would like to take a step back and acknowledge, of course, the macro environment amidst the COVID recession, which has had a massive impact in Bitcoin and in assets globally. So, of course, as a result or in reaction to the COVID recession, we see an unprecedented amount of dollar emissions into the economy, with the US dollar reaching all-time high. And there's and the fears of inflation coming out of it, even though that hasn't been the case yet. Furthermore, we see that the debt to GDP ratio in the US and in other developed economies has surpassed World War II levels, which has been, of course, a sense of caution to many around the globe of how sustainable this is long term. So the value of the US dollar, measured in terms of the DXY index, dropped to yearly lows, even though it's been rebounding in the past couple of months. And there's been an increased demand to hedges outside the system, which of course some can relate to the value that Bitcoin has gained, although it's very hard to measure exactly how much. And there's also been increased speculative activity, as we've seen with SPACs, with crypto really, and many other sectors, such as NFTs even, gaining a significant amount of traction and getting into frothy territory. Finally, COVID, since we've been so constrained in our physical worlds, has accelerated digitization, which of course has been around for the past 20 years or so, but it has been accelerated to a significant degree. And all of these factors have led to a confluence in driving forces for Bitcoin that have resulted in broader adoption. And how do we measure this? So at Into the Block, we track this on-chain through the total number of addresses with a balance, which is a proxy to the number of holders. Of course, it's imperfect, as people can have more than one address, and at the same time, one address holder can have the money of multiple people. So in the cases of exchanges, sometimes they have one address with multiple people's money in it. So it's imperfect, but the growth overall, we assume the ratio stays relatively similar. And we see that this growth has, after declining in 2018, we see it recover in mid-2018, accelerate here towards the fall, and finally hit a point of inflection in 2021, starting to accelerate at a quicker rate of growth, showing the bull market momentum that we've experienced so far. The other key narrative, of course, is Bitcoin as digital gold. And this goes hand in hand with Bitcoin as a store of value. So what does it mean to be a store of value? Essentially, it means to be an asset that people are willing to hold because they believe that it will retain its value long term. So this applies historically to currencies from developed countries at least, and in certain cases, precious metals such as gold. And on-chain, one of my favorite indicators to show this narrative taking place in Bitcoin is a number of long-term holders. The reason being, if they manage to hold Bitcoin long-term, especially in spite of its volatility, it really shows that consolidated belief that they believe that it'll retain its value over time. And I put this graphic, which is not up to date, but I did it on purpose as I wanted to show that in March 2020, when Bitcoin managed to crash over 50%, it's the number of hodlers, which we identify as addresses that have been holding for over a year, still managed to increase slightly in spite of a 50% crash, which of course would have, as you might imagine, led to panic selling from those that don't have belief in that it'll retain its value long term. So I think that this really showcases how much Bitcoin has grown in acceptance as a store of value. And this ties, of course, to its institutional adoption. First, because it's a very understandable narrative, just Bitcoin as digital gold. And we see this take place, like the acceptance of it take place in on-chain indicators as well. So for instance, one that we like to take a look at and monitor closely at Into the Block is what we call large transactions volume. So what this is the aggregate volume in transactions of over 100K. And we see that this has surpassed in the past few weeks over $100 billion per day. So this is remarkable, to say the least, especially for an asset that has been created for just over 12 years. And in 2017, in the peak, it managed to reach just over 40 billion. And the average transaction size has managed to surpass 300,000 per day as well in the past few weeks and months versus 100K in the top. I derived this metric also showing just how big large transaction volume is out of total volume. So I call it like large transaction volume share. So it's a percentage that transactions volume over 100,000. So in transactions of over 100,000 makes out of the total volume. And we've seen that this share has increased remarkably throughout each cycle. So of course, in 2013, we already saw a significant amount of volume being dominated by large transactions. In 2017 as well, and in 2021, this is for Bitcoin, it's been pretty much 98% of the volume has been in transactions of over 100,000, which as well acts as a proxy to institutional activity. Those most certainly, it's not just all institutions, it's also high net worth individuals and speculators taking place. It's worth pointing out though that this is on-chain data. So it's not, for instance, derivatives where you can get 100x leverage. So this is more related to the actual activity being shown in the blockchain. And in derivatives, of course, which have grown as well significantly, we also see the increasing demand from institutions with both options and perpetual swaps. Open interest just rocketing throughout the cycle. Open options, open interest have increased over 10x as shown in the graph below, and perpetual swaps have also increased by over 8x. This is just from 2018 up to now. 2020. So compared to previous cycle, it's been even bigger difference with derivatives volume now surpassing spots as the leading source of liquidity for crypto. Now, I want to dive into smart contract platforms. So of course, Ethereum being the leading one. There's been three main narratives and driving forces behind the growth of smart contract platforms in this bull market. The first one I would identify as adoption and usage, similar to what I was mentioning with Bitcoin, as well as their store of value potential. So this is less realized, but it's starting to be pivotal for their future growth. And their growing ecosystems. So not just Ethereum, but also Binance Smart Chain, Polkadot, Solana. I'll dive into these. So in the case of Ethereum, we see that transaction activity has been growing steadily throughout the years. And this is in spite of the high fees that they have to incur, users have to incur. One second, I'm getting a question here. Q&A is not loading. All right, I'll continue and I'll get back to the question after. Sorry, guys. So Ethereum fees have increased significantly in terms of gas. So right now, with gas at over 100 Gwei, for instance, it takes sort of around $15 just to make a transfer. And to use more complex smart contracts, such as using decentralized exchange or staking or yield farming, it can be as much as $100 to make those transactions, which of course have priced out average retail users. And in spite of that, the amount of activity has stayed pretty constant. And it's also worth pointing out that the correlation between daily active addresses and price has softened throughout the years. So I put the numbers, I didn't include them, but it's also very visible that in 2017, daily active addresses and price moved in tandem, whereas in 2021 and 2020, we see these essentially take different paths. And of course, this is because there's broader use cases in Ethereum, aside from just buying Ether right now. So this I interpret as this decreasing correlation. I interpret as an increase in non-speculative activity taking place within the Ethereum blockchain. As I was talking about fees, they have absolutely remarkably grown in the bull market. So we see Ethereum fees grow to around $8 billion annualized. So this has managed to surpass, of course, so fees are in gray. It managed to surpass by a lot the fees that were being generated by the Ethereum blockchain in 2018 to a much greater degree than price has increased. And this is important because it shows just how useful and how much people are willing to pay for block space in the Ethereum blockchain. Additionally, both Ethereum and other smart contract platforms have increasingly shown the potential of their native assets being store of values within their ecosystems. So, as I mentioned with Bitcoin, the number of long-term investors is a way to track just the conviction of long-term players, which is tied then to the likelihood of it being a store of value. But more importantly, in the case of smart contract platforms, for instance, Ether is the most credibly neutral asset within its ecosystem. And what I mean by that is that it's the most decentralized asset that can't be censored within the own blockchain. So of course you have wrapped Bitcoin, which is a very liquid asset, but there you have the risk of BitGo and other custodians of other assets like wrapped Bitcoin, whereas Ethereum is completely decentralized. And this also applies to other native tokens within other ecosystems, such as BNB, Sol, and Polkadot, well, Dot within Polkadot. And finally, you see the economics behind a lot of these assets being reworked. So for instance, with the IP 1559, there is expected to be a decreasing supply as transaction activity grows within the Ethereum blockchain. So more on the growing ecosystems, we have seen in this cycle the increases in launches from credible smart contract platforms. So we see in 2019, for instance, Cosmos, and in 2020 we saw Solana, Binance Smart Chain, Polkadot, and Avalanche. In the case of Binance, this is the second blockchain they launched. They already had Binance Chain. This one acts more as an Ethereum fork, and they have been quite successful as a low-cost alternative, albeit more centralized to the existing Ethereum protocols. So we see that forks and bridges. So in the sense that a lot of these, for instance, Avalanche has the Rainbow Bridge that allows Ethereum assets to interact with Avalanche platforms, go there and back. So we see a lot of these leading smart contract platforms interacting already with the existing ecosystem within Ethereum. And of course, by doing this, the users can benefit from the lower fees and higher transaction throughput that these networks provide. And finally, with the growing ecosystems within these smart contract platforms and Ethereum as well, we've seen adoption finally, and not just vaporware for these decentralized applications. Put in perspective, we've seen the aggregate market cap within the top 10 smart contract platforms surpass over 400 billion in this cycle, and the market share that each of these provide is towards the highs that it managed to reach in 2019. So this was when EOS had previously had sort of a late bubble within the cycle. And now we've seen, of course, Ethereum took a lot more market share in 2020, along with its adoption, but we see it spike again. So other smart contract platforms taking away market share at an increasing rate so far in 2021. And we've seen the last topic for the webinar is just how emerging sectors have led the way in actual adoption in crypto in this bull market. So before that, I would like to take a step back and sort of provide this framework that was proposed originally in 1997, but placeholder, the venture capital fund, puts into context well for crypto. So there are capital assets, which are usually tied to cash flows and the expectation of cash flows benefiting holders. So this is typically the case with equities that could potentially provide a dividend either right now or at the future that will benefit their shareholders from the cash flows that these companies produce. Then there is consumable or transformable assets. So this is the case with many of the commodities that there's sort of the utility value or the value from using these assets. And there's finally store value, which is tied to the perception of the money that it has value. So it's a little more psychological, and it has to do, as I mentioned before, with just people's belief that it'll retain its value over time. And in crypto, we've seen traditionally Bitcoin and Ethereum sort of touch these two, so consumable and store value assets. So in the case of Ethereum, with gas, it's consumable, and it's potentially a store of value, both Bitcoin and Ethereum, as I mentioned before. And with tokens right now, what we're seeing, and which has been a leading development in the cycle, is that they actually have cash flows, which for one is a lot more understandable for traditional investors. And second, it's a lot more comparable to traditional investments. So we've seen protocols like Uniswap, for instance, and Compound generate cash flows, which then you can start creating models of how to value these assets. And this type of narrative has led a lot of innovation and a lot of improvement and progress in the industry. So these types of frameworks apply to many of the leading sectors that I identify in crypto. I tried to put these in a chronological order. So stablecoins have been around, I believe, Tether since 2015. And then we see oracles, for instance, like Chainlink. And we see, of course, in this cycle, we've benefited, well, the crypto market as a whole, from the growth in decentralized finance, non-fungible tokens, which is often equated with digital art, though they're much broader than that, and decentralized storage, which has been growing significantly with Filecoin and Ocean protocol getting a lot of traction, or at least hype in the past few days, and gaming as well to a lesser extent. And all of this has been fueled with decentralized applications sort of making sense really to the investors right now amidst the whole COVID recession and the reaction, as I explained. And this tweet sort of narrows it down well from Matt Huang from Paradigm, the venture capital fund. They say it's that crypto has never had a why now. So because of the unprecedented money printing, decentralized money becomes a viable alternative. And censorship, which had spiked significantly with the deplatforming of Donald Trump. There's increasing value in decentralized web, essentially disintermediating platforms and bringing more power to the users. And we see this, so the case studies for DeFi and NFTs, which we have dove into in adding to the blog. So I'm running out of time, so I'll go quickly. But we see DeFi increased with over 2 million addresses using interacting DeFi and on Ethereum. Total value locked increasing by over 60x within a year. And we see growth in the other ecosystems, like I mentioned, in Binance Smart Chain, Solana, and Cosmos, for instance. And overall, according to DeFi Llama, we've reached over 100 billion TVL across all of these blockchains. And NFTs had their viral moment, of course, with people's 69 million raised at Christie's being the leading moment identified. We see, of course, NFT volume increase remarkably in 2021 and some notable sales in the case of CryptoPunk 7804 and McDonald's even teasing today that they'll be launching an NFT. Dapper Labs, Nifty Gateway, and OpenSea have led the way in this market. So a few key differences versus 2017. First, as I've hinted towards, the protocols that are live now, you can actually use, which is a huge increase from just believing that something will have use one day, as was the case with 2017 ICOs. The use cases are much broader. So rather than just having to speculate in a token and hope it goes up, right now you can actually use these tokens. In some cases, these tokens can bring back dividends or proxy dividends in the case of like SushiSwap's token, stake token, for instance. There's been a whole revamp of the token economic designs behind these tokens that essentially allowed these to accrue more value rather than just being a useless utility token like most in 2017. And there's been a lot more people in the institutional world buying into these narratives. Of course, most of it admittedly being in Bitcoin, but spreading through slowly towards Ethereum and other applications. And so what comes next? Just next week, exactly a week from now, the Coinbase IPO will be launching, which is expected to be another stamp of approval for institutions to acknowledge that crypto is something real, that this bull market is here to stay. I can't speak on the cycles continuing because it's still uncertain, but there's a lot of points of inflection for crypto that are yet to come, like the Bitcoin ETF, which is rumored to launch this year. Ethereum Layer 2 finally launching. Well, it's already launched to some cases, but Optimism and EIP 159 should be launching at some point late spring or early summer. Multi-chain, so I hinted on this a bit, on the bridges between one smart contract platform and another, making it a lot easier and cheaper for users to access decentralized applications. And finally, I do anticipate that we'll have a continuation of the bubble and the partners and the patterns that we have seen in 2017 and before, and then of course the crash and restart of the price innovation cycle. So I hope you guys enjoyed the webinar. Sorry if I rushed a bit, I had a lot of content to cover. Subscribe now for the next webinar. Our CEO, Jesus Rodriguez, will be talking about our new social analytics. Subscribe now in the chat. We posted the link to register there. And I sincerely hope you guys enjoyed. I appreciate you guys making your time to come here. Hope you guys learned a thing or two. And if you have any questions, feel free to drop them in the chat. I'll be taking a look at it as we speak. All right, so the questions are already starting to come in. Fernando Villar is asking, what are some ITB indicators to watch out for when the bull run is over? That is a great question, Fernando. Although I would love to say that there is just one indicator that will show this and will say, oh, bull run is over. It's very hard, as you can imagine. One that I have looked at particularly as analyst and into the block to show that the market's getting too frothy is the number of traders. So that's like I showed multiple times the number of hodlers. We also have an indicator called the number of traders. So this is hodlers, which is addresses that have been holding for over a year. We also have the number of traders, which is addresses that have been holding for less than 30 days. When that spikes like crazy, like price, that essentially means there's a lot of speculative activity. And if that ties in with long-term players, so hodlers, decreasing, I would start to get worried. That's all I can say. Of course, not financial advice. Some other questions. Thank you, Stefan, for the comments. Thank you, Jim. Glad you guys are liking this. Dietmar comments, asks, how do you perceive this cycle? As something taking all of crypto the same way, or will there be substantial differences between various ecosystems and tokens? So great question, Dietmar. I hope I'm pronouncing that at least partially correctly. Yes, so I think right now, for the first time in crypto, there's actually like more measurable fundamentals. So we can actually look at the data and see like, hey, Ethereum is actually getting traction, or there's actually transaction activity in the BSC ecosystem or in Solana. So the data is actually transparent with blockchain. So I do, and we have noticed that so far. So for instance, the ecosystems that have been gaining actual usage that I just mentioned have been vastly outperforming other smart contract platforms such as EOS that have not managed to reach the expectations set in their initial IPO. Not to speak badly about EOS, but we've seen this divergence essentially between the 2017 protocols that were just hype, also to a lesser extent with ICO tokens, of course, versus those that have actually reached to the expectations. And the key metrics for each vary by use case, but I think the market's starting to mature. And over time, and as more cycles take place, I certainly expect fundamental valuations of these to start settling more, and technical analysis potentially being less useful as it has been. More questions. Paul, thank you. I'm glad you enjoyed it. Greg asks, I joined late. Did you speak at all about Cardano? Any thoughts on it and how it will evolve relatively to Ethereum? Hi, Greg. So I mentioned it partially within the smart contract here. So how Cardano has gained share, and light blue here. Didn't go too much into detail. So Cardano has been shipping some important protocol upgrades recently. So far, I haven't seen too much actual usage, to be honest, on the protocols being built on top of it, though there's a lot of promise behind it. We'll see if it materializes, but so far it has performed well. And there's the possibility of smart contract platforms, of smart contracts actually being used in Cardano at some point soon. So that's as much as I can speak about it. Other questions? June, thanks, glad you liked it. Another question, do you think decentralization will be in the next future? Will people value it, or will they just go for the cheapest solution? So great question again. I think especially now that we're seeing growth in some more centralized and more efficient chains, that right now it's quick and easy to adopt just to go for the centralized solution, especially when it comes to like yield farming and chasing quick returns. But over time, I expect that the value, or the other way around, the issues with these chains that are more centralized will start to emerge, especially if they don't become more decentralized and transparent. We haven't seen it yet, but for instance, they can start to censor their users if they're not acting a particular way. So for instance, relatively tied to this is the digital yuan, which is being built on the blockchain in China. And I read the other day on the Wall Street Journal that there'll be, since it's programmable money, they'll have restrictions, for instance, on what they can spend their money in or how long they have. So they tested, I believe it was like putting limited amount of time that people can use to spend this money to stimulate the economy. But of course, it's a very authoritarian move. I don't think these smart contract platforms here will get to that, but I'll definitely think the value of having the decentralized play will come out more as decentralized platforms start having issues either through security or just censorship. More questions. When is Solana, Polkadot, Cosmos, etc. data coming into the block? Great question, Brendan. Believe me, I would love to have all of these supported. The issue is the reality. These blockchains have completely different distributed ledger architectures to the ones we currently support. We already support many. We already support 16 blockchains, and we're working on more. So keep an eye on those. But it's a highly complex process for you to understand. And believe me, we want to add all of these, and hopefully at some point later this year, we'll be able to support all of these assets and blockchains that you're mentioning. Nauman asks, would there be a recording available? Yes, we'll be posting that tomorrow in our YouTube channel. So feel free to check that out and share it. Paul asks, could you mail your presentation to attendees? Yeah, we'll be having the presentation in SlideShare and also on the YouTube channel. I don't know if all the attendees will want it, so it's probably easier if you just look it up yourself. Are you using any advanced graph theory to find communities in the Bitcoin graph? This would allow you to find, for example, all Binance addresses. This might explain the differences that sometimes occur between the various on-chain analysis platforms. So yeah, we have a significant amount of advanced machine learning going into our graphs. So for instance, for the exchange flows, I didn't include them in the presentation, but yes, we're working on making this more intelligent to be able to separate one platform from the other, and of course give you the best, most transparent data that we can. Paul asks, are we seeing regulation in the crypto spaces by governments going forward? I think they'll most definitely will try at least to have some type of regulation in place. The issue is it's very hard to regulate. So once it's completely decentralized, it's harder there's no central point of failures, or it's harder to censor, which goes back again to the issues with more centralized blockchains versus more decentralized ones. So I think they'll eventually try to step in. I saw a very positive development yesterday with Fidelity, Coinbase, and I think was Paradigm and Square launching the CCI, crypto something initiative, which will essentially serve as a lobbying institution to promote positive regulation of the space. So I think it's coming. We just hope it has to be positive and not tamper innovation. One more question, and this will be the last one from Catalin. From the 16th blockchain, do you watch? There is Elrond blockchain there. If yes, what do you think about its potential in the future? So no, we don't support Elrond at the moment. I can't speak to it too much. I've researched it to a certain degree, but I haven't seen that much traction in usage beyond the token price. So I won't add more to that. Thank you, Francisco, for your comments. I'm glad you liked it. I have some more questions, but unfortunately I have a meeting to attend. So thank everyone for attending. Hope you guys all have a great day, and make sure to attend the next one. See you guys, and thank you very much.